Good morning. My name is Felix. I'm the host of the Forward Guidance podcast on Blockworks, and it's an absolute honor to be joined this morning by Mohamed El-Erian. It's great to have you at the Digital Asset Summit.
Thanks for having me, and it's wonderful to be here.
Yeah, super excited for this. So we're talking here on the morning. It's Fed Day, so let's talk and get right into it. What's your expectation for the Fed today? What are you going in there? Obviously, everybody's expecting a pause. But what is your high-level outlook for what you're looking from there? It's also a dot plot day, so we'll have the summary of economic projections. So what are you looking for there?
So normally look at three things. What are they going to do with interest rates? What are they going to do with communications? And what are they going to do with the dot plot? Simplest thing on interest rates, nothing. Communication, they're going to try to pivot from we will be cutting rates because of good news, because of inflation coming down, to we may be cutting rates because of bad news, because growth prospects have changed. And they're going to have to somehow do this while not worrying people because inflation expectations have gone up. So that's a really tricky communication that Chair Powell is going to have to do. And then on the dot plots, everybody is expecting them to take the GDP growth down to 2%, and then slightly push up the inflation forecast. This notion of a whiff of stagflation. It's not strong, but it's a whiff of stagflation. The big question mark is what do they do with quantitative tightening? Do they pause it, given what else is going on, or do they continue? And I suspect it's about a 70 to 30 probability chance that they will pause it at this point.
Mm-hmm. Yeah, that seems to be an interesting one. And my understanding is the discussion around pausing quantitative tightening has to do with the debt ceiling dynamics that are occurring right now. We've already cut QT in half. We're at $45 billion a month now. What do you think is the market impact of something like pausing quantitative tightening? Because obviously the direct impact is on bank reserves, but a lot of folks look at what's happening on the bank balance sheet, Fed balance sheet, in terms of how that starts reflected in liquidity and therefore risk assets. So do you see that as a market moving dynamic or just something that needs to be done to ensure that bank reserves stay ample?
So it's helpful at the margin for yields, keeps them lower than they would have been otherwise, helpful at the margin for risk assets, but is it really substantive? No, it's just helpful at the margin.
Yeah, makes sense. And something you mentioned there, it's the issue with soft data, the survey data. So inflation expectations have been skyrocketing recently, but when you look a little bit deeper into it, it's actually this significant dispersion is occurring where Democrat-leaning survey participants are very concerned about inflation expectations. Republicans are almost worried about deflation at this point, and independents are somewhere in the middle. So how do you think the Fed is trying to gauge through this soft data that seems to be quite noisy?
So there's two ways of dismissing the soft data that has been uncomfortable. One is saying it's all about politics and we shouldn't pay attention. The other one is saying that it hasn't been translated as yet into the hard data, so you shouldn't worry about it. Both, I think, are misleading. I think we have to take the soft data seriously. There's other surveys that shows you that both households and companies now have a higher inflation expectation than they did before. So it's not just politics. There's something going on that leads people to think that prices are going to go up higher. And it's not just the short term, but the longer term. Don't take it seriously because it's not reflected in hard data. It typically takes 3 to 6 months for soft data to become hard data. So it's way too early to say this is not consequential because you've got to see what's going to happen over the next few months.
Are you a believer in, let's talk a bit about inflation here. So are you a believer that part of inflation is a psychological phenomena? Because if so, it would make sense that you could dismiss this surge in inflation expectations as just political. But if people change their purchasing habits, their consumption habits, do you see that as actually having a tangible impact on inflation?
So it could go either way. And this is why it gets tricky. And that's why economists are always accused of saying on the one hand or on the other hand. There's a demand effect and there's a price effect. Higher prices tend to discourage consumption. You discourage consumption, it means you have less dynamism in the economy and you grow less. On the other hand, high inflation makes you ask for higher wages to protect your real standards. Now, if we hadn't had the very unfortunate inflation experience of 2021 to 2022, which was a bout of what economists call unanticipated inflation. No one saw it coming. And it went all the way up to 9%. If that hadn't happened, I wouldn't worry so much about the survey data. But because that has happened and it's in the minds of both households and companies, you've got to take that seriously if you're the Fed. And you hear companies, if you want information content, listen to what companies are saying. Companies are worried about higher costs. Companies are asking the question, can we pass on the higher costs into higher prices? Will demand hold up? And companies do not want to repeat the mistake of 2021, 2022, when they waited too long to adjust.
The issue of inflation just seems very difficult to ascertain post-COVID. So, obviously, this January, we had the inflation print that came in hot by all accounts. And it seems to be this recurring theme that every January, the first month, we get this really hot print, and then furthermore, it slowly decreases. So we had the CPI print last week. We saw core CPI month over month. In that January print, it went up to 0.4 month over month, came down this last week to 0.2. So how are you looking at the overall inflation outlook right now?
So it gets really complicated because if you then go from the components of the CPI into the components of the PCE. In January, it was don't worry, because the components that go into the PCE are soft, even though the data is hotter than expected. For last month, it's complete opposite. The data is softer than expected, but what goes into the PCE is hotter than expected. I think you've got to step back and ask two questions. One is, what are the 6-month moving averages? And there, everybody agrees that the fight against inflation has stalled, that at best we are plateaued. Now, that wouldn't be a problem if the Fed had a 2.5% to 3% inflation target. It is a problem because the Fed has a 2% inflation target, and it needs to decide, does it do something about it or not? If it was really serious about a 2% inflation target, the market would be speculating about when is the next hike, not when is the next cut. But we also know something else. The big bet on inflation was that inflation was up here, goods were disinflating, and that was bringing down the inflation rate. The big bet is that this would come down faster than this would go up. And what's happening now is this is starting to go up. And that's the concern that people have about inflation.
Mm-hmm. Yeah, so to your point, the market is not speculating on hikes in any means, they're speculating on cuts. We've gone from, back in January, I think we were at about 1 cut priced into the market. We, in the past couple of weeks went up to almost 3. I think we're settling in around 2.5 cuts right now. Do you see that as fairly priced?
I think if you put a gun to my head with what we know now, I think we should expect 1 cut. But we are living in a really fluid world. I mean, the word uncertainty is used a lot, but ultimately there are 3 things that people care about: fundamentals, technicals, and valuation. And all 3, Felix, are being upended right now. And that is a world that we haven't seen for quite a long time, where this is not COVID, this is not a shock. This is things that are being created internally, endogenous to the system. That means that the operating paradigm on fundamentals is in play. What does the trade regime look like? What does the public sector look like? What would other countries react? Lots of uncertainties, let alone the positive ones, the innovations, how quickly will it take for AI, life sciences, quantum, robotics. Then you have the technicals. Before it was the US is better. Now we've had the largest drawdown in US equity exposure in favor of Europe. And then even when you go to the third one, valuations, it's no longer clear what valuations should be in a world like this. So this is a really, really tricky time. And it doesn't surprise me that gold is at a record high, or was at a record high this morning.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Okay, I want to double click on that framework for inflation that you have there, because I think about it very similarly. So to your point, core goods has been the great disinflation force, whereas services, especially, shelter has been quite sticky. We're now seeing core goods start to rebound higher, and bringing forth what's been going on with tariffs and the growth outlook and what's been going on there. Setting aside what's actually going to happen with tariffs, we are seeing tangible changes in the economy already. We're seeing a huge front running of the manufacturing sector, of imports into the economy. And so do you see that as, where are we at in that front running? Has it been completed? And now the rubber meets the road, in April 2nd, apparently, for the tariffs, the reciprocal tariffs actually occur. But how is that whole dynamic affecting the growth outlook?
So most people agree on what the immediate journey. It will be more bumpy. You hear this from the economists, from analysts, you hear it from the White House. It will be bumpy. There will be little disturbances. Where people disagree violently is on the destination. And you are all too young for what I'm about to say, so excuse me, but I'm going to do it. This could be the Margaret Thatcher, Ronald Reagan moment, where someone comes in and decides to fundamentally alter the structure of the economy. They're willing to absorb the short-term cost, economic, social, and political, because they believe that the destination warrants it. And those who believe we're in that moment will tell you the economy will come out with a streamlined government, with a private sector that's unleashed more, with debt dynamics under control, and with a fairer trading system where other people start paying for their own defense and not the US. Then there's the other possibility, which is the Jimmy Carter possibility. That policy pushes you into a stagflation, which persists. And then you dig yourself a deeper and deeper hole, and getting out becomes harder. I was recently in a meeting with people I really respect. And I said to them, which is it? Is it the good restructuring, or is it the bad restructuring? The range of views was 80-20 to 20-80. And this is what we really don't know. We know the journey is going to be bumpy, but we don't know yet what the destination is going to look like.
The approach there, I want to get into the why that they're trying to do this. Why are they trying to restructure? So we're all trying to your point, parse through where, let's get into the fiscal side of things. So where are President Trump and Treasury Secretary Scott Bessent trying to lead us? So, comparing the first term where there's a lot of talk about ensuring, the stock market does extremely well. This time we've seen a 10% correction in equities, and we've seen the rhetoric come from the administration that they're highly focused on the bond market and the 10-year yield. So why are they trying to do this? Why are they even trying to get the 10-year yield lower, do you think?
So they're trying to detox the economy. That's the word that the Treasury Secretary used, detox the economy. Detox it from what? From a government sector that's too large, too indebted, and whether it's doing it now or not, but will ultimately crowd out the private sector. And how does it crowd out the private sector? By pushing interest rates higher and higher, make it too expensive to borrow, and then you have a problem of growth. So their notion is that we need to detox the economy. We need to shrink the private sector. We need to bring interest rates down. Otherwise, you get into these awful debt dynamics where interest payments take up a larger and larger part of your budget, and there's nothing you can do about it. So the plan has three elements to it. One is you shrink the cost of the government. You fire people, you get rid of the fat, if you like, of the inefficiencies. It's a tricky thing to do. Most of us would support it, but how you do it is probably more important than what you do. That's number one. Issue number two, you lower interest rates. And you lower interest rates by saying, this is my goal now. I don't look at the stock market anymore. The put isn't in the stock market. The put is in the fixed income market. And you try to manage our collective expectations to lower interest rates. And then the third way you do it, which I've been talking about, is you go to the holders of debt and ask them to swap into very, very, very long maturity US treasuries. And if you do that, you take the pressure off interest rates and you take the pressure off the debt dynamics. You effectively are reducing your debt in a present value sort of sense. So that is the approach. It's a very tricky one to implement, and we're going to see how it goes from here.
Mm-hmm. It's interesting you mentioned that. I read recently, Niall Ferguson had an op-ed in the Journal recently, and he quoted Adam Ferguson, an economist from the 17th century, where he mentioned that when any great nation, when their interest payments were larger than their defense expenditures, that nation falters. So let's just unpack that notion of, you mentioned the debt is unsustainable. I think a lot of folks would love, there's this argument, let's just go back to how things were the past 4 years. It was a great economy, it was doing great, but also at the same time, that great economy was financed by a lot of short-term bills. That was the focus, because to your point, not a lot of people wanted to own duration throughout that circumstance. So, why is it that this debt situation is unsustainable? And what's the time horizon for that if we just, kept things as it were?
So first, Neil Ferguson, who's a friend, called it the Ferguson Law. And he looked historically. And when, as Felix said, when interest payments become higher than defense payments, then you have two dynamics that set in. This one will continue to go up, this one will continue to come down. And that's what he's worried about in the world we live in today. Look, the US has a much longer runway for debt viability than the rest of the world. But it doesn't mean it's infinite. And it doesn't mean you shouldn't start doing something about it now. The best way to deal with debt is to grow. There's only 4 ways we know of dealing with too much debt. One is you grow. You generate more income that allows you to raise standards while meeting your debt and paying off your debt. So growth is by far the best approach. The second approach is austerity. You just keep on cutting and cutting and cutting. That works one round, it works a second round, but if you're not careful, you start undermining growth and you end up in a worse situation than you were before. The third way is what's called financial repression. We've done a lot of that already. You tax creditors and you subsidize debtors. That's why we took interest rates to 0. That's why we did QE that took the Fed balance sheets to 9 trillion. That's why Europe went to negative interest rates. And then the fourth way is you restructure the debt, either voluntarily, convince people to go out the yield curve, or you default. If you were to rank these 4 things, growth dominates in every world compared to the other 3. The other 3 have a lot of collateral damage and unintended consequences. So if the US can continue growing solidly, it doesn't have a debt problem. But if it slows down significantly, it does. And whenever someone tells you, you hear someone say, oh, don't worry, the economy is slowing down, but we're not going into recession. The question has to be, what is it slowing down to? Because there's this concept of stall speed. If you're on a plane and the plane is still moving forward, but is not moving forward fast enough, it will lose altitude. And economists worry about the stall speed. The guess is stall speed is about 1%. So where are we now? We used to think the economy is going to grow by 2.5 to 2.7. That's how we entered the year. The IMF is still at 2.7. Now we're seeing a massive round of downward revisions that are somewhere between 1.7 to 2. So that's where we are. We're still not anywhere near stall speed, but we're getting close to it.
Mm-hmm. Okay, so for that framework, let's set aside the austerity component for a second here, and I want to dig into the dynamic of growing out of it and then trying to refinance in some form or another around it, because it feels like those are the two key levers that Scott Bessent and President Trump are trying to approach here. So, my first question is, it feels like they're trying to, this detox period that we keep hearing about, to have a short-term, little growth slowdown. That goes against this idea of trying to grow out of it. But then on the same vein, and let's get into the debt refinancing components, and let's go deep here. You're by all accounts a fixed income legend, so let's get in here a little bit. But my big question there is, what are these levers that can be played with? So there's a lot of talk about what could it look like for Treasury Secretary Scott Bessent to move from this previous administration approach of focusing on issuing short-term bills towards issuing longer duration coupons, which has been something that the Treasury has avoided by all accounts for the last couple of years. There's talk of issuing century bonds to other countries in exchange for security guarantees. How do you think about these debt refinancing dynamics there?
Okay, first, your first part of your question was on growth. They don't want growth to slow down, but they're willing to tolerate growth slowing down. They'd rather growth doesn't slow down. But if it is the cost of a much better destination, then for them, and to use their words, the pain is worth the gain. So if we have to sacrifice a bit of growth in the short term, that's fine, because we're going to increase our growth potential. It's like someone going back to retrain, to go back to learn a new skill. You give up income in the short term, but you increase your income generation over the long term. And I think it's good that they appreciate that there is that trade-off, and you have to assess how confident are you that you can limit the growth reduction, and how confident are you that you're actually going to get to a better destination. On the debt side, you said it. I mean, they are looking for different ways to try and reduce the burden of debt. You can either reduce the burden of debt by lowering the interest cost of debt, or you can do it by extending maturities for a very long time, where the present value of your debt comes down. And that's what they're pursuing. They inherited a difficult hand because the previous administration, like you said, funded itself at the short end. And that is being refinanced at much higher interest rates than they were before. So that is what they're battling against, because if they did nothing, then the interest cost curve would go straight up.
Mm-hmm. Absolutely. And the third one there is this X factor, and it relates to where we are today at a digital asset summit, is stablecoins. So the big discussion here is who's the marginal buyer of debt. One of the fastest categories of marginal buyers of debt has been stablecoins. So how do you think about stablecoins as it relates to U.S. dollar reserve hedge money, and as another tool to be incorporated into being buyers of duration?
So first, it is an important invention that deals with both the supply and the demand side. So it's a good addition to what we have in the ecosystem, as long as they really are stable coins and they're not something else, right? And there's a question about how do you ensure to people these are really stable coins and they're not something else. But it is an important addition. It's an addition that's going to continue to expand, and it's not going to go away. But it also does something else, is that you're starting to increase the form of money in the system. And as you increase the form of money, you slowly undermine the core role of the dollar in the system. Because people, and this is true also of Bitcoin, it's true of crypto, people now have a much bigger range of choices in the ecosystem, not just of payment, but the ecosystem of saving. And that issue is now being institutionalized. So think of you as an individual are being both pushed and pulled into that world. You're pulled because the barriers to entry are coming down. You have institutions not very far from here who a few years ago were calling this thing a fraud, and now actively have one of the biggest mutual fund in that space. So access to it has become much easier. So you're being pulled into that world as an individual. You're also being pushed into that world because you're seeing what's happening to the system. You're seeing that the system is fragmenting, and you're looking for diversification. And you see this in the amount of asset allocations now that explicitly make an allowance for things that a few years ago they would not touch.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Let's explore that idea a little bit further. Do you think that if we extrapolate, a few years down the road, could you see stablecoins potentially replacing money market funds as a globalized digital version of it? Or do you see those two things as separate entities?
I see them as separate entities because the regulators will see them as separate entities. Right? You can be part of the ecosystem, but if you're going to dominate the ecosystem, you're going to trigger a reaction from the regulators because there is tremendous seigniorage in the system. And if you try to move that seigniorage violently away from traditional elements, you will get a reaction. That's why, from day one, people got pushed into corner solutions, said that whole thing, stablecoins, crypto, is either a fraud or will dominate everything. And I kept on saying these corner solutions are dangerous because they're both misleading. It's not going to be this or that. It's going to be something in the middle. And the key issue that's going to determine the middle is adoption. Adoption is the most important thing to have. And what we're seeing is the holder base changing, maturing in a manner that is good for the longer term.
Mm-hmm. And then to that point as well, there's the Bitcoin discussion of everything as well. So, I don't know about you, but I did not expect one of the first countries to have a strategic Bitcoin reserve to be the US dollar reserve currency country. How do you think that sits within this framework of US dollar hegemony? Does it, protect it? Does it strengthen it? Or does it potentially, make it riskier in terms of it remaining the reserve currency?
So far, it's not as a big a deal as people had hoped for. Okay, it becomes a big deal when people say, instead of holding dollar reserves, I'm going to hold Bitcoin reserves. Okay, it's different from saying, I have all these Bitcoins that I've confiscated, and now I'm going to move them from one part of the balance sheet to another part of the balance sheet and call them something else. Okay, that doesn't fundamentally affect the flows. What fundamentally affects the flows is to say, I am now going to substitute this for that. And that we haven't seen so far. So it's not, it could happen in the future, but I would not view this as a dramatic influence right now.
And what about Bitcoin being used as a neutral reserve asset between countries for trade? So, obviously related to this US dollar hegemony is this idea of the petrodollar system that, global oil is settled in dollars for the most part. Do you see any use case for something like Bitcoin, which is this neutral reserve asset, in an era where we've seen US treasuries become, turned into a weapon of sorts? We've seen, during the Russia-Ukraine war, we've seen, Russia, US reserves be frozen. So does that lead down a path where we could see Bitcoin become this reserve, this neutral asset that's used for global trade flows?
So when I travel around the world, the question I get asked the most is, how did Russia do it? Do what? Not invade Ukraine. How did Russia continue to trade while not being part of SWIFT, while not being allowed to use the dollar? How does it do it? And if you analyze it, it does it by using 4 different currencies. It's a really inefficient system, very inefficient. but it allows them to both export and import without going anywhere near the dollar. And the reason why I get asked that question is because countries are worried about the weaponization of the payment system. They're worried about the weaponization of investments, not just trade. They're worried about assets being frozen for political reasons. And they're trying to look at substitutes. That's why gold is doing what it's doing. Gold has broken every single historical correlation it's had. Why? Because central banks are buying on a consistent basis as they seek to diversify at the margin away from the dollar. So if you were to let this system run, suddenly Bitcoins has a role to play internationally. However, that is what worries the regulators. That's exactly what worries the regulators. And that's the balance that they're trying to strike, which is tolerated in the system, but don't let it misuse. And whenever you see something that has an 80-20 proposition, you know one thing for sure. The US will tend to embrace the 80 and worry less about the 20. Europe will focus on the 20 and regulate away the 80. And that's a little bit as to what we're seeing in the reaction to crypto right now between the US and Europe.
Yeah, you mentioned it a couple times that gold is doing fantastic. Broke 3,000 all-time highs pretty regularly. How do you think about the correlation between gold and Bitcoin? Because it feels a lot of people have a lot of different opinions on what drives the price action of Bitcoin. There's been times where it feels like Bitcoin is quite highly correlated to gold. Other times it's a 0.9 correlation with NASDAQ, and it just feels like a levered NASDAQ. So how do you characterize the main price action drivers of Bitcoin, and how does that relate to this idea that gold is just hitting all-time highs all the time? Meanwhile, Bitcoin's actually struggling right now recently.
So gold has an identity. Bitcoin has multiple identities, and that's the difference. And if you look at Bitcoin, you see that the person who's the marginal price setter changes over time. It goes, sometimes it's the speculators who are in and out. Sometimes it's the fundamentalist adopters. Sometimes it's the institutional adopters. And depending on who is the marginal price setter, the correlations look completely different. And that's why you get this multiple identity. But it's what you expect in an asset class that's maturing. I grew up in emerging market bonds. And the correlations were crazy. Sometimes we traded like a risk asset. Some other times we traded more closely to bonds than before, and we changed. And it all depended on the margin. Why? Because you didn't have a fixed identity that dominated, that if you like, acted as an anchor. And it's part of your maturation process. It takes time for an asset class to mature.
Mm-hmm. I'm glad you brought up emerging market bonds, because I do want to finalize our conversation here by having a global perspective, because I think there's some really interesting dynamics that are occurring right now geopolitically. So let's talk about Europe first. As we've gone through the motions of what's been being pursued by President Trump and his administration, we've started to see a significant shift in Europe right now. We're seeing Germany propose a $500 billion investment. We're seeing them take off the debt brake dynamics that they've had, where, for those that don't look too deeply on it, Germany is a country that is, believes in austerity. They don't want to run deficits. We're now seeing the opposite of that, and that led to some major changes in markets. We saw a huge surge in bond yields, and with that, we also saw a huge surge in the euro. So that's happening in Europe. And then also in China, we're seeing some major fiscal impulses. So first off, how are you thinking about Europe right now? And then also China?
So the market has completely upended its US versus Europe relationships in the last few months. So much so that let me give you two factoids. One comes from Danny Berger at Bloomberg, that if you look since the start of last year, you would have made as much money on the DAX as you would have made it on the Magnificent Seven. The other one is the interest rate differential between US government bonds and Germany. At one point, they were above 200 basis points in favor of the US. They've come down to about 140. That's a massive relative change. Reason why is that Europe has had what's called the Sputnik moment. The notion in the 50s when the Soviet Union, the USSR sent up the Sputnik rocket, and suddenly the US woke up to its vulnerability to space missiles. And then the US got its act together on the missile, on the space program, and completely transformed that space. The view now is that finally Germany is going to have to pay for security. The minute it releases the debt brake, it can also pay for infrastructure. It can also pay for Europe-wide programs. And suddenly Europe looks very different than what was before. I think that is true, but not to the extent that the market has priced it. I think the market has gotten carried away with this Sputnik moment. It takes a really long time to find what you're going to buy, to do it, to get the money into the economy. It's, unless you do helicopter money where you give everybody money, it takes a long. So I think the market has gotten carried away, but it is a paradigm change. That's a fundamental change in how you think about Europe.
Mm-hmm. And I also brought up China as well, because my main reason for that is it's interesting to see what's going on in those countries where the yields are starting to increase. We're seeing the fiscal unshackling at the same time that the opposite is happening in the US. And at the same time where, you just look at where positioning was going into the year, everybody was in Mag 7, everybody was in US equities. That's the place to be. But, you just think about, European asset allocators. If they're down 10% on Mag 7 and they weren't hedged on their currency during that moment as well, and then the euro goes up 6%, that's a double loss for them. So how do you think that those dynamics affect the flows into US equities?
So we've seen it. I mean, record outflows from US equities, record, biggest ever. And we've also seen the biggest ever switch from equities to the rest of the world. So it's not just that people were reducing equity exposure. No, they were reducing US equity exposure in favor for the rest of the world. So you've seen this happen, and you've seen it happen because for a very long time, US exceptionalism was unquestioned. It was there to stay. I used to describe the world simply: the good, the bad, and the ugly. The good is the US, the bad is China, the ugly is Europe. Right now, it's not as clear as it was before. The good has become less good. The bad is the same, but the ugly suddenly has become better than the bad. So it's quite a jumble right now.
Mm-hmm. Yeah. And so just to finalize here as we wrap, where do you think that leads us for risk assets for the next 12 months here? Do you see this as just a major recalibration or rotation? And with that, obviously, we talked a couple of weeks ago and you mentioned to me that your risk of a recession is rising. It's not quite the base case yet, but yeah, how does that reflect into risk assets for the next rest of the year here?
So my recession risk has gone from 10% to 25 to 30%. So it's not dominant, but it is a fatter tail than it was before. Some people are at 20, some people are at 70. And that goes back to where you believe this bumpy journey is leading to. Mm-hmm. That is the key question that you've got to figure out if you're asset allocating. Now, if you are not willing to make that call, the answer isn't to go neutral to 60-40. The answer is to go barbelled. Go into as beta agnostic returns as you can find. And there's actually lots of beta agnostic returns where you can generate from 3 to 6.5%. And then on the other side, go to tactical and opportunistic, because you're going to get a ton of volatility and you're going to get a ton of attractive entry points. And don't get stuck in the muddled middle where you really are having to make a call about something that's really uncertain, which is its destination. So, become more barbelled as opposed to trying to stay in here and be really exposed to something that I don't think any of us know for sure.
Well said. Well, Mohamed, that's all the time we have. It was an absolute pleasure to have you here today, and thank you again.
Thank you. Thank you, everybody.